Good afternoon. Welcome to today's session on lifecycle investing, where we're going to be looking at Herbalife nutrition out of the US. It's Sunday, the 3rd of June, and my contact details are there. Always enjoy some feedback. Any ideas or any questions or any queries, please touch base. And so before we start, this is not advice of any kind, just sharing some ideas based on investing experience and some ideas of the Adizes Institute from out of California, of which I'm the Australian managing director. And so these ideas are those of myself. They're not backed, if you will, by the Institute out of California, although we work a lot with investors in doing due diligence on investment opportunities and also post-investment acceleration. And keep in mind, timing is everything. And these ideas hopefully will shed some light on some additional things you can look at from a timing perspective, which means sitting out sometimes, when to get in and when to get out. And this should be seen in, partnership with your other due diligence work that you do on an investment. And it's just difficult to get all the information that's required for all companies. Most of these ideas are used with smaller companies where investors can get access to management to get in, but it works quite well on large companies, as we're going to go through. And a lot of this theory that I'll talk about shortly, it's separate from the methodology. Just because something sounds good from a theoretical point of view, there's actually a methodology behind it that you need to be aware of. Now, in addition to Herbalife, I will briefly mention these other three companies. Blue Sky down in Australia that we've been writing about recently and been talking about well before the Glaucus report came in. Just a few thoughts on Tesla to help the ideas stick a little bit, and also just a bit on Apple. But these will be the subject of other videos that you'll be able to link to and get access to. So, right, let's just get in. So, developed by Dr. Ishak Adizes over 50 years ago is this organizational lifecycle model that you can plot organizations on. It's a little bit different to normal lifecycle models, or not normal, but other lifecycle models that are out there. And it very much has some similarities to the human life cycle. The only thing is that we don't believe organizations have to die, although the majority do. And you can move up and down and back along this life cycle as an organization, whereas, as we know with humans, that is not the case. Now, just to jump in quickly, we're not measuring age. A lot of life cycle models look at age, or as time goes on. We look at a number of variables, and we'll go through those. Now, a bit like the human life cycle, there are different things based on where you are at the life cycle. So there are normal problems, and they are dependent on where you are at the life cycle. So if I said there was a human that cried all the time, didn't sleep through the night, and wet itself, well, if it's an infant, that's pretty normal. If you're still doing that when you're 35, I can assure you it's not good. It's a problem. So what was normal versus abnormal is actually depending on where you are in the life cycle. And often when we're analyzing things or situations, people say, "Oh, this is a problem." Well, if it's a normal problem that will go away as the company moves up the life cycle and moves back along it, then energy shouldn't really be put into that. It should be put more into the abnormal problems. And from an investing point of view, we sort of see normal problems quite regularly, but it's really abnormal problems that we start to really get a bit more focused, because it's the abnormal problems that are going to cause the issues. And then there are fatal problems. And again, just in the human life cycle, there are fatal problems. So you need to be able to understand an organization in terms of its normal problems, its abnormal problems, and its fatal problems. Then there are other things such as the leadership style. There are different leadership styles required at different phases. And often from an investing point of view, we will see an investing style that is very normal from one phase, but then you see that same style, but the company's trying to move into another phase. That creates problems. That creates an opportunity to invest on the short side or take some form of derivative. And things like goals are very different. And when we see, say, infant organizations with the goals of prime organizations, you just know that a lot of capital is going to get burnt and a lot of things just aren't going to go to plan. And there's many more. There's lots more, and people that are interested in this kind of it's not a sole approach, as I've said. It's an additional approach to investment analysis and taking and exiting positions. I'd be happy to answer questions. So if we're not measuring age, what are we measuring? And just quickly, so blue sky was roughly around between this go-go adolescence phase, and we saw a number of abnormal problems creeping in that have led, we think, to a few fatal problems, but that's the subject of something else. Tesla is just exhibiting so many abnormal problems for this phase of the life cycle, which we'll touch on later, but we see a big opportunity in Tesla. Apple, we've been able to plot on this graph many different times over its life cycle, but we just wonder if it's starting to reach its sort of fall status, if not towards a little bit of aristocracy, but that'll be the subject of future videos. And then Herbalife, the subject of today, it's very clearly demonstrating some hallmarks of aristocracy. And the problem with aristocracy is that whilst organisations are still quite functional and financially healthy, it's often an automatic slide into recrimination, and that's when the big opportunity comes to short or go on the short side. So what are we measuring? Well, the first thing we measure is flexibility. When you're very young, you have very high flexibility, but then as you age, it starts to come down, and then it starts to get really, really low. And then when you're really young, things like predictability, self-control, controllability, ability to get forecasts and all those things, it starts off very low, and then it starts to grow. It sort of comes up, and then, as we know, it starts to unfortunately come down. Now, where these two lines meet together for the second time, unfortunately, that's all over Red Rover. No control, self-control, predictability, flexibility. That's it. But where these two lines meet the first time, that's what we describe as prime. Well, it's at least part of prime. It's where you've still got good flexibility to respond to a changing world, new markets, new trends, new consumer demands, whatever it might be. But you now have the controls, you now have the predictability, you now have the self-control. And sort of when you have that, and you've got these additional things, such as being able to grow revenue, profits, and cash flow at the same time, that is not easy. And so that is a key sign of prime. When management is separated from ownership, when it's no longer requiring the founder or the founders to sort of control it, they've managed to get the controls and the systems that a broader set of people can actually run it. The customers are continuing to grow, and people want to join the thing and whatever it is, and competitors are seeking to copy. That's what we sort of look at when we look at a prime organization. And so if we have a look at the life cycle chart, or the model there with the and this together, you can sort of see in the early phases of courtship, infant, go-go, even adolescence, you can just see when you've got really high flexibility with low controls and self-control and predictability, that's going to lead to some things that are normal, abnormal, and fatal. And then the same as you move into the aging phases, when your controls are just incredibly high, very predictable, but you've lost your flexibility, that your flexibility has been killed off. And then as things go on, even controls start to decrease. You can imagine there's going to be some abnormal and some fatal things coming out of that. And so if you can understand these things, and so, Tesla is in a situation where it's highly flexible. They're doing all sorts of things that they really don't have a right to be doing, with very little control. I mean, predictability. I mean, they forecast different things so many different times, and they haven't been able to keep to it. and you'd hardly describe some of the things happening as, high self-control. And the interesting thing of this phase is it's the same phase that we put Enron and Valiant Pharmaceuticals. And so there are some things here that we see quite a number of patterns emerging and quite similar. But that will be the subject of a different thing later on. Apple, this one's a tricky one. I've probably put the logo a bit too far to the right there, but it just seems, and for another video, that the flexibility is starting to fall out of it. They're falling behind in a few things. And yes, they've got emerging markets and some services and higher margin thing coming through, but it does seem to be that the controls are very much outlying flexibility. And keep in mind this model, as I said earlier, companies can come back. This model does not require things to die necessarily. So I'm not suggesting in any way go out and bet against Apple, but you use this life cycle approach to start studying companies, to start tracking them, just to see the information coming out, going, oh, that's interesting. Where's their cash flow at? Where's their profitability at? Where are the debt levels? And what we're looking at today is going to be Herbalife, because I really think they're sort of well past the aristocracy and moving into recrimination phase, which when you have a record stock price and you're at this side of the life cycle, this is going to be an opportunity in my opinion. But again, this is not advice. This is education on this model. So let's just have a look at a couple quickly. Go-Go. That's that go-go phase here. That's the early phase. It's a bit like a toddler. It's sleeping through the night, but now everything looks wonderful. New markets, new products, all of these different things. They don't yet have the controls, and they don't know they don't have the controls yet. It's a bit like a toddler doesn't know what they don't know. And if you ever try and have a real conversation with a toddler about all the things they're doing wrong, it generally doesn't go all that well. But if we just have a look, and the normal problem is confidence. But when it turns to be complete arrogance, that's abnormal. A go-go company is very eager, but when that leads to lack of focus across lots of things. Sales orientation, absolutely. Sales orientation and premature profit orientation. Now, this one's a bit complex, and some people find that a bit odd, but I'll come back to that later. Sales beyond the capability to deliver is normal, but selling despite an inability to deliver quality, that's when it starts to become abnormal. When there's insufficient cost controls, that's normal, but when there just doesn't seem to be any form of cost control, when there's insufficient staff meetings or the discipline inside of the staff meetings, if it's sort of like all these things on the go, there isn't like a level of communication around problems and execution. And when there are almost no meetings and the meetings that occur are quite dictatorial and they're on the run, that's when it starts to become abnormal. When there's no consistent salary administration, that's totally normal. But when there are overpaid employees with dysfunctional targets, we saw that in the case of Blue Sky. We've been talking about it for a little while. If your options and your incentives are going to get paid once you've hit a certain funds under management number, that becomes your primary focus, and you will make that funds under management number hit. You will take on businesses that might not be in the long-term best interest. You will do all sorts of things to meet it, and again, that becomes abnormal. In a go-go company, it is normal that the leader or the leaders are surrounded by clacks, by these bravo, these people that always laud and clap after these people. But if you start to see key people deserting and people leaving, that is not normal. That is abnormal. That is a problem. In go-go, a normal thing is that the leadership's expectations are always inflated, but if that turns to paranoia, that is an abnormal problem. There's always a hope for miracles in go-go companies. It's when they start to rely on miracles that becomes the issue. And the company can often be subject of criticism. You sort of, you're putting your head above the parapet. But once the company becomes the object of legal action, that becomes abnormal. And often these go-go companies, again, because of the low controls and predictability and high flexibility, their targets are always quite aspirational. And it's, an objective person outside of the company would find it hard to believe. But once you start seeing them become a little bit dishonest in the plans and targeting, and they're saying things that they know are not right, or they're coming up with strategies that are just not what you would describe fully honest, that's abnormal. So look, if we take a Tesla, let's go through. I mean, the arrogance in the last few months has just been increasing amazingly. If you look at the analyst call, the last person I know to sort of behave that poorly on an analyst call was the Enron, the Jeff fellow. Lack of focus. I mean, look at Tesla. Look at Elon himself. All the different things that he's got going on, and he's leading this. And then you take inside Tesla all the different things that are going on. There's just a total lack of focus. Now, you couldn't accuse them of a premature profit focus by any means. That has not been on the top, but they are now starting to sell despite an inability to deliver on quality. When you look at some of the reviews on the Model 3 and some of the long-term things on Model S's and the X's, they are just pushing the production lines and creating products that are just not quality. It just does not seem to be any form of cost control. When you have a look at a lot of the things that are emerging and just have a look at the financial numbers, it's a problem. People like Elon, they got to this position because they're dictators. They sort of, here's my idea, here's my capital, you're on board or you're gone. And that's fine to get a business off the ground, but once you start getting into this phase, if you start to become over-dictatorial, the relationships really start to become a problem, and problems stop getting identified or aren't identified as well as they should be, and there isn't the collaboration required to get things done. This is a fairly recent one. Overpaid employees. I can't really comment on the rest of the employees, but the new incentive structure for Musk is just unbelievable. The way that it's so centered around share price, that is so dysfunctional as a target. That really hasn't got anything to do with the health of the company or anything else. To be able to hit those targets, you can do all sorts of different things. So I see that as a very abnormal problem. The list of executive departures is amazing. Jim Chanos keeps sort of talking about the list that they've been curating, and makes the point that the last company you saw with that many people leaving was at Enron. It is just an abnormal problem when you have your talent, and keep in mind the company doesn't yet have the controls and the systems and the processes at the managerial level. So when people leave, they take with them their IP, their knowledge, all those things, and that is a problem. I mean, Elon's paranoia has certainly been increasing. When you look at the attacks on journalists, when you look at the amount of energy that's going into Twitter and fighting all these things, it is an absolute issue. More and more, they seem to be just relying on miracles. The numbers that they keep trying to say that they're going to hit with production. Now, finally, the company is starting to become the object of legal action. There are things starting to emerge. The Solar City related party aspects, I think, is going to come out. But the problem is, because the share price went up afterwards, there really isn't a loss yet. So it's going to be interesting to see how that pans out, given the amount of debt that got added to the business. The self-driving, they call it autopilot, but even last week or a couple of weeks ago, the autopilot managed to drive into a police car. I mean, you can't really make this stuff up. So more and more of these legal actions are going to start to come out. And whilst the company might not admit it, there are just clearly some things that these targets and some of these plans you just couldn't describe as honest, whether it's timing on production or different products and all these things. To me, it's leaving the realm of aspirational, and it's getting close to dishonesty. So anyway, there's an example of, on the left-hand side with the normal problems, people have been talking about shorting Tesla for years, and we've just sat there going, no, they're normal. That's normal. All those things are normal. Don't bet against those kinds of normal things, and the share price has done that. But now, since these abnormal issues are coming out, this is where I think the opportunity comes. Because rarely do these sort of hardcore entrepreneurial types that have had huge success in the past, rarely do they find a way to course correct. Normally they need a burning platform and everything's screwed up around them before they make a change. So again, think back to Enron. Have a look at all the ticks that were sort of in the Enron aspect. And so, yeah. Now, because what happens in the model is that if the founder doesn't find a way to transition, we have this phase that we call the founder's trap. And if you actually do the numbers and have a look at it, the vast majority of all companies started, whether they're public or private, it's not relevant. They don't survive the founder. You know, either abnormal problems sort of are not dealt with, or the founder leaves before the adolescent transition occurs and the organization dies. And so many times on that latter one, you see these really successful entrepreneurs, they've sold the company, they're lauded as heroes, but in reality, in the background, the company dies. Why? Because they didn't institutionalize the things that they did. They left the company. The company was actually a well-tailored suit for them. It fitted them perfectly. And nobody else knew how to run it. And that's what that adolescence phase really is about. It's about growing up. It's about the company getting its own controls, its own self-control, its own predictability, reducing some of that flexibility, implementing the systems and process. And so anyway, where you ultimately want to be is this place that we call prime. A prime company is the land of the quadruple bottom line, growing profits, growing cash flows, growing revenues, growing sort of customer satisfaction. And it's just market leading, and people are wanting to join, investors want to buy. It's strong from a control, but still flexible from an entrepreneurial point of view. The structures and the systems are working well. It's integrated. It's got a good track record. And the biggest problem that a company like this has is it just doesn't have enough good people to put into the new products that it's developing. And the abnormal problems are really if it starts what we call the red thinking, protect our gains. If there's an emergence to slow the pace of change. And so, if you take, for us, Apple absolutely has been there and I would argue is still there in many cases. And I think where Bill Ackman got things wrong is that, sure, he had I guess a moral and an ethical thesis, but Herbalife between 2011 and 2014 was clearly what we would describe a prime organization. It was in the land of the quadruple bottom line. We'll have a look at some of the numbers later, but it was just hitting all those things. And we would say never bet against a prime company until aging starts to show, well, there's fraud. But just keep in mind, again, fraud, having been the managing director of a listed company and dealt with investors and whatever else, the primary thing is their investment. And moral and ethical issues are a little bit outside. And what Ackman was trying to, I think, say was that there's all this fraud, but when you have a look at some of the documentaries and some of the things, it was more of like a moral and ethical thing. And so what we would say in this model is, okay, if you have that thesis that this thing ultimately isn't sustainable, the time to tackle it is not whilst it's a big prime organization. You really need to be able to wait and strike accordingly. And I believe he lost about $4 billion on that. No, that was the Valiant one. He only lost about $1 billion or so, 800 million on this particular one. And so what the problem with prime is that it's the hardest to get to and the hardest to stay at. And if you do nothing, you will automatically start to move into the fall and aristocracy. And it can be accelerated by a premature aging event. And I think with what Bill Ackman started, that was a premature aging event. That company had to start defending itself. It started, leveraging its balance sheet. It started accelerating its buybacks. It started doing a whole lot of things that just started to age it more and more because it was under the attack from Ackman. And so maybe what Ackman did was just accelerate it, but timing is everything. And so the majority of time we just see the companies start to age. Now companies can fight aging by proactively trying to stay in prime. In life, we have change. And if you do nothing, things just fall apart. If you take a $1 million Rolls Royce and go and park it in a garage for 10 years, when you come back to it to try and start it, it's not going to start. Why? Well, time is change, and change by definition is destructive. Things start to fall apart. Things start to disintegrate. And so what you've got to do is proactively have this constant fight to stay in prime of wowing the customer, making sure that your administration, that's the A, doesn't get too out of control, that you're able to keep refueling momentum through new products and services, that you keep building your bench of people, and that there's a relentless pursuit to be the best, and just ensuring that you're continually changing, so then that way people don't get used to the status quo. And that's Apple. That at least has been Apple. In another video, I'll put forward why Apple should be not I would still say be broadly long on it, but just start to watch some of the symptoms, maybe starting to age it. And so, as we say, without fail, if you do nothing, these prime organizations, they start to age. And once you've gone through the fall, you move into aristocracy. And aristocracy is where it's still very cash-rich and financially strong, but now sort of it's more legal, finance, accounting. They're sort of starting to call the shots. People are starting to be happy with the status quo, and most of the problems get externalized. That people start seeing them less in their control and more out of their control. Revenue starts to become stable, or even sometimes fall, but a lot of energy is still going into the financial engineering, increasing prices or cutting costs or supply chain optimization, share buybacks, all those kinds of things to keep the share price propped up. And energy is going to that rather than that hardcore customer innovation. But the core markets start falling. A lot of these companies start looking at acquisitions. We're going to look at Herbalife. I can't see that being something. And the past is often seen as the golden years. Leadership's appetite for making bold moves has diminished, and companies they start building these massive sort of castles to their glory. And if you think of Apple with the spaceship, I mean, there's a prime example of a company with far too much cash building just some unbelievable stuff. And when you have a look at the increase in their fixed assets and their office costs over the last 3 years, their investment is just huge. And what starts to happen behind the scenes is as political gamesmanship starts to come into it, and there's sort of really negative consequences for people who speak out or disagree with their superiors. And so again, if these companies do nothing, they're going to move to the next phase, which is recrimination, because there's only so much you can financially engineer. The world keeps changing around it, and if you're not staying in that prime position and bringing new products, new services, new things that are able to replace the old ones, and so companies either have to rejuvenate or they go the other way. And outside of the investing space, this is what the Institute does. This is what Adizes does. Is it works with organizations to help them do this. And so this is why I think Apple's coming there a little bit. You can see not all of these things, very few of them, but it's just starting. And I definitely think when we have a look at it, Herbalife is there now. Herbalife, I think, is somewhere between aristocracy and recrimination. And when you have a record stock price and some of the other shenanigans going on, that creates a really interesting opportunity. So let's have a look at it. Recrimination, this is when it all turns to mush. Now, clearly, Herbalife can't fully be at recrimination at the moment, because one of our things is that once the stock price it will start to plummet. Obviously, that hasn't happened, but customers start to bolt and key employees leave. And I think we're about to see that. If we look at the number of senior people at Herbalife that are leaving and are selling big chunks of stock, it's high. Anyway, I'm not going to read through this. If you want to read through it, just pause this video and go for gold. So the one thing to understand with recrimination is this is really where the energy starts to get sucked up. And I just want to share this equation that the Institute has, that we feel the key underlying asset, the key underlying skill, the key underlying capability of any successful organization is to be able to manage the problems and opportunities caused by change. And it's difficult, which is why there's this cross here, and that's the subject of many other things. But you've got to just keep reacting, managing the problems and opportunities that are constantly caused by change. If you can do that day in, day out, year in, year out, you will be successful. If you look at a company that got into trouble or has disappeared, they didn't identify and solve problems, or they didn't identify and capitalize on opportunities caused by change. Now, to do that, you need to have energy. You need to have energy available, and you need to have energy going into this particular, what we call the change loop. You've got to have your energy going in there. And we get that, we say that's through integration. When you are integrated, when, say, needs are meeting capabilities, when you're as one, when you're it's a bit nebulous, but when you are integrated and together, that's when that energy really becomes available to do that. But in this fixed energy world, we know that at any point in time, energy is fixed. 100% is 100% at any point in time. It's not me saying it, that's Newton and scientists. And we know that energy is predictably allocated. It first sort of gets sucked into the negative, which we sort of describe as disintegration. That's the opposite. So if you are dragging a log across the ground, the log is not going to move until you can have enough energy to get over friction and inertia. If there's not enough energy to get over friction and inertia, that log's not going to move. And it's the same thing here. First, the energy is going to be feeding the disintegration. And what is that? Well, the disintegration is this sort of constantly changing thing of all these different conflicts, different styles, interests, decisions versus implementation, roles, perceptions, definitions, values. You can see in some organizations, even countries, even at the family level, energy first has to go into all these sort of conflicts, and only what is left over can go outside through this energy available. And that's, if you are highly disintegrated, let's say 95% of your energy is being sucked or becoming unavailable by all these conflicts, it's going to leave you very little energy to go out and achieve success. But if you've got low conflict, if you've got low destructive conflict of these things, that leaves a lot more energy. So we sort of say that success is a function of the energy first lost or made unavailable to disintegration, and that is left over for integration to ultimately manage that change loop. And so if we look at a couple of examples, let's look at the United States. I spend a lot of time in the United States. I have a lot of colleagues and clients and friends and families. And so this is not a United States bashing thing, but look at the US. Look at how much disintegration is occurring at the moment between different styles and interests and perceptions and values. And ultimately, that is sucking up so much energy. They are not, in my humble opinion, they're not managing this change loop. They are not solving problems. They are not capitalizing on opportunities. Have a look at the United Nations. I mean, the United Nations is just the basket case. But in this context, when you've got the different styles of all the different countries, and they've got all their different interests, and the conflict of deciding what to do and implementing, and different values and different definitions and perceptions, no wonder the place hardly gets anything done. Blockbuster. When you actually analyze and actually have a look at how Blockbuster sort of disappeared, there was just this conflict of styles and values and definitions and perceptions and interests. Our writing and our blogging and sort of investment analysis on Blue Sky, these conflicts were building up behind the scenes. And then, as soon as Glaucus came out, bang, it was like a massive disintegration bomb. And if you have a look at what's happened since, you can really drill into the different styles. I mean, if you look at the Rob Shand and the chairman, I mean, those styles were very dictatorial, which is normal for an early stage company. The interest between them and their shareholders, the perceptions, the values, all of these things sucked a lot of energy away. And Tesla, have a look at Tesla at the moment. It's just starting to creep up between the different styles, the perceptions, the interests. It's just consuming. And so this little thing is important, that, again, part of the investment and thesis is where's the energy going? And when you see a really integrated company that has got all its energy capitalizing on opportunities, solving problems, that's where you want to have your money. But if you see a company that's just disintegrating, that's falling apart, that's got all of these unharnessed conflicts, going long is a bit of a risk, and is there a short side to take it? So again, these are just some tools to help analyze some investments, because I've seen a lot of companies, and you see them all the time, great technology, lots of money in the bank, but can't get their shit together, can't actually get some stuff done. And when you have a look at it, it's to do with integration. Okay, so I'm just going to broadly give you the life cycle in investing. This is just my approach and what I do to work with investors and help them understand some of these things. This is not advice, okay? This is not investment advice. Please don't go and do anything along those lines. But firstly, we understand where the position is in the life cycle. Use it as a filter, long, hold, short. So Tesla is an example. Clearly, that is a filter for the short side. Apple, as I discussed, that's sort of like okay, you can be long, but sort of hold, just as long as revenues, cash flows, and profits are continuing to grow and all those things. But, keep an eye out. And for Herbalife, clearly that's going to be a short thesis. But then it's about understanding normal, abnormal, and fatal. So again, with, say, a Herbalife, with Ackman, there were a whole lot of things that were normal there, and that I would argue was missed, and the timing of the short position was just wrong. Same with Tesla. In the last few years, going short on Tesla in the environment of normal problems was not a good thing. Have a look at the share price. But now that we're moving into the abnormal, that's and I would argue fatal. Understand their secret to success of position. So again, are they integrated? Are they disintegrated? Can we see the disintegration in things coming out? Is there something that's going to lead to the disintegration? Then understanding the market conditions and the feeling towards the stock. So again, when Tesla in 12 months ago had huge positivity, it's very different to now, where there's a lot more negativity coming out between Musk, between Tesla, between a whole lot of investors. And the market conditions, again, with low interest rates, easy access to capital, a whole lot of different things occurring, they're sort of leading to some pretty exy valuations. And just on this one, the feeling towards the stock, again, even after Bill Ackman's sort of attack in 2012, things have been really reasonably positive. But now that we're seeing a lot of these things happening, it's starting to become negative. And what are the price to earnings and a whole lot of other ratios? If you've got a company that's clearly the price to earning ratio is already incredibly cheap, their share price is already low. Even if you've got a short thesis in the life cycle model, is there sort of enough juice to come out of this orange? Is there enough to still go? So it's not just because, okay, this is clearly now entering a dysfunctional, abnormal set of problems. Is there actually money on the table? And on the long side as well, if you've looked at it and say, okay, well, this company's coming out of adolescence and it's now moving into prime, but if it's already priced at 100 times earnings, okay, you've just got to be a little bit careful. And then keep looking for catalysts for a change, and that's both on the long side, the short side, and the hold side. And really important in all these things is what could go against my bias. With Tesla, you've got to be really careful, because for a start, people like Elon, whilst in the long term get themselves into big trouble, in the short term they tend to be able to pull a rabbit out of their hat. They tend to be able to do all sorts of things and sign deals and new products that just get everybody sort of excited. So again, if you've taken a short position, they come out with something that adds 50% to their capitalization. Even if the life cycle model is right, there could be some things that are going to go against what your bias might be. And so just to go through, in summary, I'm not going to read through each of these things. You can pause it. But, for us on, say, Blue Sky, there was things around the founder, internal disintegration. Apple's about holding. It's starting to show some some prime signs of aging. It seems disintegrated. It doesn't seem like the new iPhones and stuff are closing the gaps. And here's some things for the potential buyer support. Tesla, clearly short. It's clearly disintegrating. The PE ratio is unbelievable. And the competition from so many other car manufacturers is here. They've got this federal tax credit reduction that's coming in once they hit 200,000 models sold in the US, when all of the other companies are only just starting to use those tax credits. It seems to be unable to raise equity at the moment. Whilst I've not dealt with the SEC, I have dealt with ASIC, and when your stock price is at that level and you're not raising capital, generally there's something behind the scenes as to why you would go and tap the debt market, especially after Solar City added those level of debt. So there's something there. And the safety issues. Musk seems to be taking the approach that with new technologies and whatever else, a few people have to die. Whether the broad world accepts that or whether regulators accept that, but I can just see these things coming out. But of course, on the other side, if their Model 3 production does come good, I doubt it, and they should be big, not bit moves in power. And if they are able to pull off a really large equity raising, if they were to pull in $5 or $6 billion and get the Model 3 and do some other things in power and announce something in China or something, that could blow all this stuff out of the water. And then Herbalife, which is what we're really going to be going into in a bit of depth. To me, this is on the short side. It's an aristocracy into recrimination play. There's science of aging, financial engineering. I don't really know enough internally to know if they're integrated or disintegrated, but their price to earnings ratio is just huge. And, the catalyst for change, Carl Icahn has already just sold a big chunk. Not all of it. I think he sold about 25%. But if there continues to be a loss of revenue and profitability, and keep in mind that the Boomtime CEO is gone, he's not there anymore. And that always is, these guys on the internal side, they tend to pick it pretty well. They hand off to somebody else. That somebody else doesn't want to be the idiot that sort of stuffed things up. So they start concentrating on, again, keeping share price high and keeping investors happy. And that leads to a bit of dysfunction. But at the same time, on the opposite side of my short bias, if Icahn was to stay, if growth returns, if new products, new markets, all those kinds of things, you've got to just keep an eye out. And so Herbalife, again, it's not advice, and I'd welcome questions, doubt, or disagreements, because I like I'm hoping to make these things to get a bit of a dialogue. If you think I'm fundamentally wrong, or you have some questions, or you've got something to add, my contact details are on the beginning and the end. But, the story is there's this multi-level marketing. It's a pyramid scheme. They admitted that in their last 10K. And a guy called Bill Ackman comes out with a $1 billion short in late 2012. The problem for him is that it just kept going up. You can see there was a bit of a dip, but he just took this short and then got into a fight with another huge investor, Carl Icahn, who those two clearly didn't like each other and had some stuff in a previous businesses that didn't go well. I believe Bill sued Carl, and Carl wasn't happy with that. And so Carl comes in on the opposite side and just starts buying and starts providing support and sort of demonstrates that somebody with deep pockets was here to protect. And at the same time, a fellow Australian, John Hempton, he was, by all accounts, fairly negative on it to begin with, did a bit of research, and he too went long. And he too went, well, it might not be the most morally thing. And I think even at one point he said he didn't like the underlying product. I can't remember the exact words, but didn't like the taste of it or something. But it was, as he pointed out, very profitable. People enjoyed it. I read a blog where he had gone to Israel and seen firsthand some successes and some good things. And so he's been long. He's been bullish. But using the life cycle model and some of these things, we think that the time for that bullishness is gone. With Carl starting to exit, and I'd be very surprised if Ackman didn't come back in. We think our ideas and processes validate that. So if we have a look at the share price growth, and if you look at today of a market cap of about 9 billion, so if we take the December 31 numbers, that's sort of like 2 times revenue, 14.5 times operating income, 19 times income before tax, and then 35 times net income. Now, it must be said that because of some of the tax law changes in the US, they paid a higher tax rate, it seems, by repatriating some funds, so that 35 times might be a bit unfair. But still, you couldn't say that this was cheaply priced, in my view. So let's have a look. If we have a look at 2012, 2013, 2014, you can see that people are joining. Pretty well every market is growing. You have this sort of growth. These are the sales leaders. These are the network, the people out there, sort of out and about doing their thing. And you can see 2012, 410,000 has grown to 486,000 in 2014. That is prime. That is partly prime when you've got that underlying growth. They just had that momentum. And if you look at 2011, 2010, 2009, that's where that growth came in. So for Ackman to try and take that company down when it was in its prime was just a bit daft. But let's have a look now. 15, 16, 17. It is falling. It is flat. It is falling in its major market. It's sort of growing markets. It's definitely flat. This is sort of, here's where its growth is coming from. But even with this growth, we've got this overall fall. And in their big market, America, and they've had a whole lot of issues with local regulators, and I won't go into all the ins and outs there, but this is aristocracy related issues. They're sort of past the fall of flatlining, and they're starting to actually fall. Let's have a look at the income statements. I've stitched 2010 all the way through to 2017 together. In these previous years, this is prime. We're growing revenue, we're growing income, and we're growing operating cash, in a strong manner. This is prime. Again, Ackman trying to sort of take the company down with these kinds of cash flows and operating. There's just too much momentum. Even if he's right, it just takes a long time to put the brakes on. But now, look at the sales. Look at net income. Look at income before taxes. I mean, she's just trending down. She's just sort of all over the place. That is aristocracy. And then you've got this thing called this other operating income, which is quite interesting. They won a thing against their auditors, and it was about 30 million. Plus, they get some grants from China. And they even say here, there's no assurance that the company will receive grants in future periods. Now, given that in China, they've also had, they can't use the same model, they can't use the same pyramid model, so they've got something different. It's just a bit intriguing. And just while I was digging through the notes where all the real good stuff lies, it's just some interesting things here that just smell a little bit of financial engineering. They've consolidated their shipping, but when you actually have a look at these amounts, you can see what they've been able to charge for shipping is falling not insignificantly as well. But I could be wrong there. But when they start moving things around and changing things, like, why not just keep that the same? Interest expense. I mean, look at the growth of interest. I mean, that is financial engineering in its core. Let's load up this balance sheet. We're in incredibly low interest rate environments at the moment, and they're already paying that level of interest. I mean, what happens if rates continue to rise? It's going to be quite impressive. Have a look at their earnings per share. So share price has still been growing, but have a look at that. Even with massive buybacks, taking the number of shares that are outstanding and reducing them. Again, this operating cash, it's all over the place. It's sort of trending down. It's at best sideways. But a prime organization has an ability to sort of grow these things year in, year out. This is down, then up, then down, then up, and it's going to be really interesting to see what happens. Again, lots of cash, but have a look at this working capital. I mean, look at the increase of working capital, but without the increase in revenue. The gross profit percentages are almost the same. So again, I don't fully understand why, and I'm going to do a bit more digging, but that just seems really intriguing to me. And look at these debt levels. I mean, this is pretty big. So again, we've got record stock price with a high PE. If performance continues to slide, the next phase is this recrimination phase. You'll start to see gloves come off, and I think it's going to be pretty swift because of some of the artificial things that have been keeping this up, which we'll talk about. And one of them is this share buyback. I mean, just buying back these shares, reducing the number of shares on issue, providing the support to the share price it's just been huge. And so what happens when there's no more share buybacks to hold up the price? So remember, our life cycle model isn't specifically a time-based thing. These things could happen in weeks, months, years, if not decades. But what happens when the share buybacks aren't there and they're left with high debt and the revenues fall, profit falls, cash flow falls, and then there's an increase in negativity into multi-level marketing? Well, that's the recrimination phase. And so the opportunity is once you've understood the life cycle model in these different phases, the percentage chance of these things is high. We very rarely see companies actually do anything about these things until it's too late. It takes a bold chief executive who's currently sort of trying to execute whatever strategy to also deal with the issues in the life cycle. We rarely see it. So I've sort of taken a lot of 2017, the full annual report, but what's Q1 saying? Let's have a look. Well, these numbers, they're not, to me, showing growth. This doesn't look, I mean, there's some okay, bottom line growth, but have a look at the United States, have a look at China. And then I must admit, and I'd love for somebody to help, they've got this sort of volume point adjustment. And when you look at the definition of volume point, they seem to be using it as a financial forecasting for product in the market. It's not dollars or anything like that. But again, we've got flatlining. But have a look at China. Look how China's gone backwards. The fact that North America's not done anything, and the fact that they talk about some additional increases if it was accounted in a different way. Now, if this is sort of a looking into the future kind of metric, again, it doesn't look all that good. And also, as I mentioned before, this comes out of the annual report. They have to operate differently in China. But what I find really interesting is the way they describe this. To allow us to operate under these regulations, we have created and introduced a model specifically for China based on our understanding as to how Chinese regulators are interpreting and enforcing these regulations, our interpretation of applicable regulations, and our understanding of the practices of others. I don't know. That to me just screams don't know, or we're setting you up for something in the future, or shit's about to get unclear or go down. Like our interpretation of their interpretation of I don't know. It just strikes me. So let's have a look here. Well, net income, slight decrease, and operating cash. So again, this isn't screaming high growth, high opportunity. This is screaming financial engineering of problems. Now, this is just really sort of basic. I just took, what operating income across the top here, multiple, but it's just little things like if investors are in the future, because they're starting to see a slowdown and the share buybacks disappear and, Carl Icahn's not there anymore to support, even if they have, say, 500 million of operating income, if investors are only willing to pay 10 times, we're still like 40% off from where we are today. And you can change this number up here to be whatever you want. It can be free cash flow, it can be profitability, and you can change your multiple, whatever. I know I have a look at this and say, well, on the upside, is this a company that's rapidly growing with lots of new, like if it was just entering, I don't know, China and it didn't have all these other things, maybe, but I mean, there's not, the upside is looking pretty problematic. So, and what could what could change the bias? Well, if there's a return in growth to America and China, but we only get our numbers each quarter, so that's you're going to have to do this. And if operating cash flow is increased and it can actually fund the buyback and pay back debt, I don't see how they're going to be able to do that. If you look at the annual report or could be the 2018 even first quarter, they're talking about having to repay in 2019 $1.125 billion of their debt, which they're either going to have to come up with cash for or they're going to probably roll over. But new markets continue to accelerate. And, takeovers are always a problematic, interesting thing when it comes to the short side, because somebody else's thesis could be that it's still quite cheap. So anyway, in summary, to me, this has the symptoms of aging, and entropy is going to ensure that the recrimination phase sort of comes home to Papa at some point. They've got this debt and interest load that's just growing unabated, and its largest markets are stalling. And the share price supported by buybacks with this bullish activist in Carl Icahn and Ackman covering shorts, these things will all have been supporting the stock. And so what happens? What happens when they're sort of gone? And so even if this is a morally bankrupt praise on people to keep their revenue model alive and all this kind of rubbish, that wasn't enough to get the market pricing them at a low rate. But if that is still the case and their growth starts to fall, I think you might see. So there's my overview on Herbalife and why I see it on the short side. I'd love for feedback. I'd love for any sort of level of engagement. There's a few little things on Blue Sky, Tesla, and Apple, but keep an eye out because I'll be doing full sort of overviews on the views of Apple and Tesla, and I've already got 4 blogs on Blue Sky that you can access. But yeah, shoot me a note. Thanks for tuning in, and we will catch you next.